Your markets news now. Asian markets fell Friday with trade tensions and geopolitical worries keeping investors from tracking a rebound on Wall Street. Investors are warning that more volatility on the markets can be expected. There have been steep losses on Asian markets this week, with the Shanghai Composite Index, for example, said to have fallen just shy of 8% this month alone. In Japan, stocks took a further knock, the Nikkei share average falling 0.4%. Hong Kong stocks also registered losses, with the Hang Seng Index losing 0.7%. Mainland Chinese stocks were a bit calmer, but still closed in negative territory, the Shanghai Composite Index closing down 0.2%. Over in the United States, stocks jumped on Thursday, giving the Nasdaq its biggest daily percentage gain since March, as Microsoft's upbeat earnings spurred a rebound in technology names and investors snapped up oversold shares. The Dow Jones Industrial Average rose 1.63%, the S&P 500 gained 1.86%, and the Nasdaq Composite Index added 2.95%. Well, after a bit of a pickup in equity prices yesterday, equity markets are languishing in the red all over again. Over in Europe, we're seeing big sell-offs. Investors are said to have the jitters after the ECB chief, Mario Draghi, is believed to have downplayed threats to the EU project in a speech yesterday. Italy's budget moves, which don't comply with EU rules, and the standoff between the UK and the EU on the former's exit from the EU continue to cause major concerns. Analysts believe the euro could weaken even further given the uncertainty. Here at home, the all-share index is trading in deep red territory, with financials the main contributor. The local currency has lost about 0.5% against the US dollar. Let's take a look at those indicators. Well, to give us his take on the latest market happenings, I'm joined in studio by Warwick Lucas. He's Chief Investment Officer at Galileo Capital. Thanks very much for joining us. It's been a long time.
My pleasure.
Good stuff. So, look, the markets have generally been trending downwards. Where's the bottom?
Right, well, we hope that the bottom is not far away. It is a period of some uncertainty. We are going through the motions now of a quarterly earnings season in the US. We're seeing some big companies coming out there. We saw Google and Amazon out, and I must say, even with a slight setback in earnings, there's some mighty share price moves there. And then, of course, we still have to see clarity on potential trade war between the US and China. And frankly, some of that risk is only going to really be over once we see US midterms out of the way. So it's a watch and wait at the moment.
And continuing with that theme, you talk about the US midterms, but once the midterms are over, then we then have to see what happens in January, because they have threatened to levy even higher import tariffs on Chinese goods.
Well, I'm sure they're both going to keep the detente up. I think the most important thing out it was that hopefully the posturing ahead of midterms is out of the way, and that on the other side the Chinese don't look at midterms as something that can be gamed, and they can actually get down to some proper negotiation, probably in smoke-filled rooms.
You touched on a couple of tech companies. There were a couple of results that came out overnight, but they were mixed. They missed, they undershot expectation. How did the markets react there too? Yeah,
I mean, what was quite interesting was the scale of the reaction to the misses. So, for example, if we look at Amazon, quarterly revenue was expected to be 57.1 billion. They came out with 56.6, and the share at one stage was down nearly 9%. So, give or take, that's between 70 and 90 billion dollars for a tiny little $500 million miss. So, I mean, it's an enormous scale of response there to that. So clearly there's a lot of bubbliness in tech stocks. I think there's a lot of growth in them as well, but the expectations are very high. So succeed and you're a hero and your share price goes high, fail even moderately and you're dirt.
And you're punished. And then here at home, Naspers, they've made commitments in terms of this investment conference that's going on. 4.6 billion rand they're going to be investing over the next 3 years in their technology business, but also very nicely in technology startups here in South Africa to help spur that growth and development and creation of jobs. That's very positive, but despite the all-share index being in the red, did we see any uptick in the Naspers share?
All right, so I think Naspers has got a very large tail that wags the dog there, and that, of course, is the 10-cent share price. So that's going to dominate whatever happens. But nevertheless, we saw earlier on in this year a 3% stake in 10-cent being sold off. That, of course, means a mighty war chest of cash there, and no doubt actually Naspers is quite pleased to be able to deploy some. So that's all well and good there, but it's good to see other companies joining in there as well.
Yeah, and might I add, they're also deploying just a fraction, because I think when they sold that 10-cent share, they got something like 116 billion rand, didn't they? So,
yeah, it was a very big amount, but they are looking as a global company. But it's nice at least that a decent whack does come back to South Africa.
Absolutely, and they can't invest all their eggs in one basket, of course. This week was the midterm budget, and it's interesting to see that Fitch came out with a report saying that they're not really convinced that the reprioritization of funds, which wasn't the 50 billion that the president talked about, but more around 32 billion rand, they're not convinced that it's really going to be sufficient to kickstart the economy. Do you think that we're going to be able to steer clear from a downgrade from any of these ratings agencies?
Okay, so I guess the quantum is always going to be a bit iffy in any case in this particular scenario. I think the key point was, well, with the stimulus, was that they wanted to say we're on a more business-friendly footing, that we're going to try and aim the country the right way and put a little bit of money where their mouths are. Not a lot, but what can be scratched around and found in the kitty, to show some sense of commitment. And I think that was the important thing here, because there had been such an erosion of confidence. What was interesting to see with what Fitch had to say was they were still maintaining a positive outlook on their BB Plus. So it's starting to sort of put us in a band of between BB Plus and triple B in the case of Moody's. So it's a moderately positive footing, but clearly there's hard work to be done. Tito is trying to grow our economy out of trouble, and frankly, under the circumstances, I think that's the best one.
We've got this investment conference, as I mentioned before. Lots of pledges coming in, some 130 billion rands worth of investment pledges. Sounds good on the surface, but guys like you always talk about this issue of policy certainty. Are we getting there? And just because those pledges have been made, will it take a lot more for them to actually be effected on the ground?
They are getting there. I think the one thing that's important to remember with business right now is that it's probably sitting on the biggest cash pile in the history of this country ever. So much cash got held back because of lack of confidence. We do at least have that powder dry. And I think that the focus on technology is also important, because frankly that is where you get the fastest bang for your buck when you do spend on capex. Okay,
we're going to leave it there. Always good talking to you, Warwick. That was Warwick Lucas. He's the Chief Investment Officer at Galileo Capital.